This is Your World at 10 on CNBC TV 18. Now, tonight we have a special guest on the show, Charles Dallara, the Managing Director of the Institute of International Finance. Well, he joins us from Washington, D.C. to discuss capital flows to emerging markets and bank nationalization in developed markets. Well, thanks very much for joining us, Mr. Dallara. Let me start out by first laying out the dire forecast on private capital flows to emerging markets that's laid out by the IIF in its January report. The report of the data says that from about $1 trillion in 2007, private capital flows are likely to come down to about $165 billion this year. My question to you is this: since January and since this report, we've had even more bad news come in from the global financial markets. So do you think that this 165 is also going to be tough to come by and will need considerable downward revision?
Well, good evening. First, let me say that it's a pleasure to be with you. Unfortunately, however, we are talking about a bleak outlook for capital flows to emerging markets, and as you suggest, it could become even bleaker. We actually, however, built in quite a pessimistic forecast, especially for the first half of the year, underlying the assumptions that have framed our estimates. So although I don't rule out some further reduction in our estimates of capital flows this year, it's also possible that in the second half of the year there could be some signs of recovery of these capital flows. So on the whole, I would say we're comfortable remaining where we are.
All right, Mr. Dallara, in fact, I'm looking at the data that you've put out in that January report, and while it's not so dismal on the front of equity investments, which are seen to decline from about $300 billion to about $200 billion this year, so $300 billion in 2007 to $200 billion in 2009, what seems to be worst hit, and this is the bad news really, is net credit flows from an inflow of about $632 billion in 2007 to an outflow of about $30 billion from emerging market economies this year. Now, this is really bad news for countries like India, which depend on external credit for large project financing, as well as for big M&A deals and all kinds of corporate expansion, and that's going to be impossible to come by this year.
Well, you're right, unfortunately. The outlook for credit flows is particularly weak as we look out to the evolution that may lie ahead for 2009. And this is going to adversely impact the overall pace of development, growth, and wealth creation in India and many other emerging markets around the world. I'm afraid that in particular, infrastructure financing projects and some general capital market fundraising by large corporations is going to be constrained. Of course, it's important to keep in mind that as global trade declines, the global need for credit also declines. And to a certain extent, what we are seeing is not only a shortage of available credit, but a sharp decline in the demand for credit, as the ability of corporations to utilize effectively additional borrowing resources is actually severely curtailed as well. There is one silver lining here, which I think is important to point out. Or maybe even two. One of them is the increased efforts of multilateral institutions around the world to step into the breach here, so to speak, and to help fill some of this gap that has been created by the sharp downturn in private flows. We see the World Bank, the IFC in particular, which is the private sector arm of the World Bank, the ADB, and other important multilateral organizations stepping up to help fill the gap. And if they move creatively and aggressively, as we believe they are trying to do, it's certainly possible that some of the hemorrhage that we're seeing in project financing could be stemmed, and we could actually move forward with some project financing that is so sorely needed to continue the process of infrastructure building and institution building in key emerging markets like India. The other silver lining, potentially, is that in the United States and Europe, there are huge amounts of cash sitting on the sideline looking for opportunities to earn returns. They are unlikely to put that in the equity markets anytime in the near future. So there is some prospect that this money may eventually, as the year winds on, move into reasonably high-grade credit opportunities, including lending to high-grade corporates in emerging markets.